Visual. Shiba walks into a bright shop called Money Rental. A shelf has identical dollar bills with different price tags. Imagine walking into a shop where you can rent money. The strange part? The same money has different price tags. A credit card might have a very high rental fee. A mortgage has a different one. A savings account shows the reverse. The bank pays you for letting it use your money. So Shiba tilts his head and asks the question that makes interest rates click. Why does money have a rental price at all? Visual. Shiba picks up a $1,000 bill with a tag that says use now, pay later. Pay. Interest rates can sound like mysterious numbers on the news, but they are closer to a price tag. They tell us how expensive it is to use money now instead of later. Once you see interest as the rental price of money, confusing headlines start to connect. Mortgages, credit cards, savings, business loans, inflation, hiring, and house prices are all touched by the same idea. Not in the same way, not at the same speed, and not by one magic button. By the end, you will understand why rates exist, how they move, and why every rate decision has trade-offs. Visual. The shop counter splits into two sides, borrower Shiba and saver Shiba. If Shiba borrows $1,000 today and pays it back later, the lender cannot use that money while Shiba has it, and also takes the risk that Shiba pays late or prices rise before the money comes back. Interest is the payment for those things: waiting, risk, and the opportunity to use money somewhere else. Think of renting a scooter. You pay because someone else cannot use it while you have it. Money works in a similar way, except the rental period can last a month, a year, or 30 years. Now flip the counter around. If Shiba saves money in a bank account, he is letting the bank use his money. The interest he receives is the small rental fee paid back to him, and it varies by bank, account type, competition, and market conditions. This is the first big aha moment. One person's interest cost can be another person's interest income. Higher rates can feel heavy for borrowers because loans become more expensive. They can feel more rewarding for savers because waiting with money may pay more. Lower rates can make borrowing easier, but saving may feel less rewarding. So interest rates are not automatically good or bad. They change incentives. Visual. A seesaw. Borrower Shiba goes down when rates rise. Saver Shiba rises a little, then pauses as a sign says, pass-through varies. Picture a seesaw. On one side are borrowers, families buying homes, businesses buying equipment, and people carrying credit card balances. On the other side are savers and lenders. When the rental price of money rises, borrowers become more cautious, while savers may pay more attention to returns. But the seesaw is not perfectly balanced. In May 2026, the FDIC national savings rate was 0.38%, while many borrowing rates were far higher. Higher rates do not mean every saver receives a huge reward. They mean the price of using money has changed. Visual. Shiba compares two snack machines, Snack Today and Snack 1 year later. Why is money today usually worth more than the same amount later? Imagine Shiba has $10. He can buy snacks today or lend the money and get it back next year. If prices rise, the $10 may buy fewer snacks. If he misses another use for that money, he loses an opportunity. So the lender asks for interest. The rate tries to balance time, risk, inflation, and opportunity. That is why different loans have different price tags in the money rental shop. A secured mortgage, where a home backs the loan, is priced differently from an unsecured credit card balance. A short-term business loan is different from a 30-year home loan. Each has its own risk, timing, and competition. In recent U.S. examples, the differences were large. The average 30-year fixed mortgage rate was 6.51% on May 21, 2026. Credit card accounts assessed interest averaged 21.52% APR in the first quarter of 2026. Meanwhile, the FDIC national savings rate was 0.38%. Same economy, very different price tags. The shop is sorting risk, time, convenience, competition, and lender pricing into labels. Visual. The shop ceiling opens. Above it is a large dashboard labeled Economy Speed Dial. Now we can reveal the bigger machine. The Federal Reserve influences the environment through the federal funds rate. It does not directly write every mortgage, credit card, or savings rate. Mortgage rates usually listen more to longer-term bond markets and inflation expectations. Credit card APRs often include a prime rate component plus an issuer margin. Deposit rates depend on the bank, the account, and competition. The federal funds rate is tied to overnight borrowing between banks. It is a short-term benchmark, not the price of every loan. In April 2026, the Federal Open Market Committee's target range was 3.50% to 3.75%. Think of it as the economy's speed dial. It does not control every wheel. It changes the slope of the road. When the benchmark rate rises, short-term borrowing costs across the financial system tend to rise. Banks, investors, and lenders update their own price tags. Some rates adjust quickly, some slowly, and some for other reasons at the same time. When the benchmark falls, borrowing can become cheaper in many parts of the system, but the exact effect depends on the product and the moment. Visual. A chain diagram appears. Fed benchmark, bank funding and markets, loan and deposit rates, spending and saving, demand, inflation, and jobs. If money becomes more expensive to rent, a family may wait before buying a house or car. A company may delay expansion. A floating rate borrower may have less room in the monthly budget. When many decisions shift in the same direction, spending can cool. If demand cools enough, businesses may find it harder to raise prices quickly. Over time, that can slow price pressure. This is why central banks raise rates when inflation is too high, to reduce overheating. But the effect is not instant. It moves through contracts, budgets, expectations, banks, bond markets, and business plans. In April 2026, U.S. CPI inflation was 3.8% over the prior 12 months. The Fed's longer-run inflation objective is 2%, and it also aims for maximum employment. That combination matters because the speed dial affects prices and jobs. Visual. The dashboard has 3 zones: too hot, steady, and too cold. Shiba moves the dial carefully. Now comes the trade-off. If rates are too low for too long, borrowing can become very attractive. More people may bid for homes, more companies may invest, and more shoppers may buy on credit. That can support growth, but if demand outruns supply, prices can rise faster. If rates are too high, borrowing can become painful. Home buyers may step back, businesses may cancel projects, hiring may slow, and revolving debt can feel heavier. That can help cool inflation, but it can also slow the economy. So central banking is not like flipping a light switch. It is more like adjusting the temperature in a building where every room reacts differently. The same rate setting can help one group while hurting another. A retiree with savings might welcome higher income from some accounts or bonds. A first-time home buyer might see a monthly payment jump out of reach. A business may postpone expansion. A worker may benefit if inflation slows, but worry if hiring weakens. They are different sides of the same price change. This is why interest rate news can feel emotional. The number is abstract, but the consequences are personal. A beginner-friendly rule is this: interest rates coordinate patience. Low rates say, using money now is cheaper, so more plans may happen today. High rates say, using money now is more expensive, so more plans may wait. Across millions of choices, that changes the speed of the economy. Visual. Back in the money rental shop, the price tags are connected by soft glowing lines to the speed dial above. And that brings us back to the shop. The mortgage tag, credit card tag, savings tag, and business loan tag are not identical, but they live in the same financial weather. The Fed changes one important short-term benchmark. Banks and markets respond. Borrowers and savers adjust. Spending, saving, investment, inflation, and employment react over time. That is the trade-off behind the dial. Visual. Shiba closes the money rental shop and turns the economy speed dial to steady. So what are interest rates? They are the rental price of money. Borrowers pay them to use money now. Lenders and savers receive them as compensation for waiting, risk, and opportunity. And why do they matter so much? Because when the price of money changes, behavior changes. Higher rates tend to encourage caution and cool demand over time. Lower rates tend to make borrowing and spending easier, while reducing the reward for waiting. The key takeaway is calm but powerful. Interest rates are not random numbers on TV. They are prices that help steer millions of decisions. And once you see the price tag on money, the whole economy becomes a little less mysterious. If this helped, subscribe to Shiba Economics for clear, friendly economics explained one idea at a time.